What's up, Denver? Welcome back to another episode. I've got a great investor guest in the studio today. He's been investing for almost 20 years. He's run the gamut from fix and flips, in-state investing, out-of-state investing, syndications, rentals, all sorts of investing activities, which are the type of investors I like to have in the studio. So I've got Matt Amundson here, who's a Denver resident, Denver investor, and also a Denver-based real estate agent in the studio to talk about your story, talk about some of your wins, a couple of the lessons you learned over the years. But Matt, I am pumped to have you in the studio, man.
Thanks for having me.
So let's jump into your story. I think you officially started investing, was it 16 years ago?
Yes, it would have been about the tail end of 2007.
Okay, 2007. So, the market was about to go through what market did. Before we talk about how you got into real estate investing, talk about where you were in life then and why you got into real estate investing and how you got bit by the real estate bug.
Well, yeah, I had always wanted to get into real estate. I just always seen the success people have had with it. Some of the late night infomercials.
The Carlton Sheets
ones.
Did you ever buy his course?
I did.
Did you?
Yeah.
Okay. I never did, but I remember the infomercials.
Yeah. So, but when I was younger, I bought it and I didn't really do much with it. So for me, it was the catalyst of, like I said, when I started investing, I was newly married and pregnant with our first child. So that was what lit the fire for me to be like, I need to get a little more financial stability, wanted to make a little more money, provide for the family. So
what was your career then?
I was a full-time musician. So I was playing the drums 6-7 nights a week, teaching lessons 3 days a week, playing all the gigs, playing all over the place. And that's also just very time intensive. You're not playing your drums, you're not making any money. So definitely wanted to get to the point where I could get to that passive income because I knew that that's where we start to have a little more freedom in our lives. And that's what I was looking for.
Okay. And so was there like a specific event or time that triggered you to get into investing, or was this the build up of, a couple years of you wanting to get in the game?
Like I said, it was just a lot of years of just kind of mulling it over and thinking about it. And then just the slap in the face of the reality of bringing a child into the world was,
you have to provide. Yeah.
It really just was all of a sudden one moment, just like snap, like wake up call. It was just like, oh, I've got to do this now.
Yeah.
So when I started out, pretty much all I could do, because I just started out with like limited amount of money. So I'd owned our primary house. And so I took out a home equity line of credit on that. So I only had like $20,000, $25,000 to work with. So basically it was I could just flip houses, right? So I was thinking, let me just try to grow that little pot of money, right? And so that's what I did. So I just found a house that I could buy with that and would, do different hard money loans, different things like that. And just bought one, flipped it, went into the next one.
How'd your first flip go?
That's actually funny. I was thinking I would buy and hold that one. And then when I started looking at how long it would take to kind of get the ball rolling with that strategy, I was just like, I'd be doing much better if I flipped this one. So I flipped it and I only made like $9,000 or something. But
for the first flip, the fact that you didn't lose money,
right? And,
you got paid for your education.
I got paid for the education there, and yeah, like after talking to some other people, years down the road, they were just like, yeah, if you didn't lose money on your first one, you did pretty well. So I kind of felt though at the time, like for me to make $9,000 playing the drums, that was like a couple months worth of work, and so I was still playing, and I did that amount of work on that deal, made that money, and then like I said, then I had a few more $1,000s to go into the next deal.
And were you like fixing up the property yourself, or did you have a GC or subs, or were you like a one-man flipper show?
No, I never wanted to do all the work myself. Just didn't want to run into kind of a lack of skill set there.
Yep.
Plus, you hear people say it's just like your job is to find money, find the deals, and then like I said, I would just kind of coordinate GCs and different people to do the work on the properties. It just seemed like a better way to get momentum going, get in and out of the property quicker. So that's what I decided to do. So like I said, I flipped about 4 or 5 in there, $9,000 or something on that first house. I think, it was about 14,000 on the next, and then got to a point where I was all cash in on, I think it was my 5th house. But by this time, the first time home buyer tax credit was coming to an end there. What year was that? Was that 2010?
I don't know. I wasn't in the game. I know what it is. I wasn't in the game, so I don't remember the specifics.
Right. I can't remember the exact timeline on that one, but this was in that crash, and the government was artificially trying to hold the market up by giving people, first-time home buyers, like an $8,000 credit to go out and buy a house. So I was under the gun trying to flip this house and get it sold with that time frame and get that buyer in there, and then it missed. So then things truly fell off the cliff. So by then, luckily, I was into that house with all cash, so I didn't have like a hard money loan ticking on that one. So talked with people, and they're like, you got to rent it out. That's the only thing we can do right now. So I was like, all right. So I looked at renting it out, and I was like, okay, could make about $900 a month on rent.
What part of town was this in?
These were East Denver, so like Colfax, Quebec area.
Okay.
Colfax between Quebec and Yosemite. So I rented it out and then just kind of looked around a bit, and I was just like, man, it'd be great if I could get some of this equity out, re-leverage it. So then I did a little digging around and found a commercial lender actually at that time, because they were having a hard time as well. So I found a commercial lender who was willing to work with me just with the single family project. So he cashed me out what I had into it, about $76,000. And I was able to take that and then go pick up 2 other rentals.
So you shifted from flipping to rentals then?
Had to. That's sometimes the market tells you what to do. And in that case, that's definitely what the market said to do. And so that's what I did.
Well, I want to highlight there, because that's not a comment for people to gloss over, because you're right. Like you follow the trends the market is doing, and a lot of people don't do that, or they don't pivot with the market. Mm-hmm. You pivoted, and that is what successful investors do.
Yeah. So that was the first time that I took like a loser and turned it into a winner, I guess you could say. Right. Because I was stuck on that property. I wasn't going to sell it, or I was going to take a haircut. If I was going to sell it, I'd had to really drop the price. So, or it could cash flow, like I said, and then I could take money out of that, re-leverage, and buy a couple other houses. Because like I said, then the market run off a cliff at that point. So there were other sellers that were pretty desperate as well. So then I was able to pick up 2 other properties, get pretty good deals on those. And then I liked not just having one rental. I've always felt like that's just about the riskiest place you're going to be as a real estate investor. Right?
If you have one rental?
Just one rental.
Why?
Because the amount of money that you build up over a year in cash flow can just easily get wiped out with like a furnace or somebody driving through your fence, or a bigger ticket item like that.
Yep.
That will come down the pike. So I was able to spread that risk out, I guess, with 3 rentals. Plus, it got me more cash flow than I was going to just get out of that 900 off that.
I want to ask you a question on that, because you talk about risk, and I know a lot of people, they scale up on multifamily. Like, hey, I'd rather have like 4 doors in a 4-plex versus 1 door for that same risk. And I was like, hey, I get that, but whether I have a 4-plex with 4 doors or 4 single family homes, I've always viewed them as the same. I'm like, hey, cash flow from property 1, 2, 3, 4, it's all interchangeable in my mind. Mm-hmm. Did you view because these are single family rentals, right?
These were single family.
Did you view them as like a global portfolio? As like, hey, if one kind of starts losing, cash from here will make it up. If a water heater goes out on rental 1, rental 2, 3, and 4 will help fund that.
Oh, absolutely. Yeah,
okay.
I think it pays to look at it globally like that. Because there were times like that where something would happen, and like I said, instead of it wiping out a year's worth of cash flow, it would only take 3 or 4 years to overcome that hurdle. So that made it a lot easier to hold them, because like I said, my quote unquote day job was playing music for a living for tens and tens of dollars. So I didn't really have a lot of financial stability behind me there. So these properties really needed to work. So my criteria at that time was, if I can get into a property and it can cash flow $500 a month, I'll do it. So those were what I was able to buy at that time. Was it
just cash flow over mortgage, or like full underwriting?
Well, at that point, I wasn't really savvy enough to understand like some of the costs to operate. So that was above the mortgage.
Okay, so just simplistic, $500 above PITI.
Yeah, $500 above that, and then like I say, then you learn through some
CapEx
trial and what CapEx is, and actually what percentage of that you think you're going to keep actually stays in your pocket. So, I mean, you're going to learn your lessons. You read the books, you go to classes, you study, and you do the best you can to prepare, but you definitely are going to learn some more lessons once you get in the game.
Okay, so it sounds like 2010, 11, 12, you shifted towards buying rentals, right?
Yeah. So that was 2010 when it switched into the rental world.
Okay.
And then around that time we had our second kid. And so, like I said, I was still mostly the musician and part-time real estate investor. So I was the stay-at-home parent. And so with 2 kids, I was kind of buried. People should tell you the second kid is 4 times as hard, not twice as hard. So that kind of put me in the weeds a bit, which is really sad because some of the classes I was going to that Charles Roberts was teaching where there were deals where people were finding the property, getting it with hard money, right at 70% loan to value, getting out of it with the long-term debt at 75% loan to value, and really not going into those deals with any money at all. You could find a good enough deal that you could get that hard money loan with no money out of pocket. Right?
The BRRRR strategy, essentially, right?
The BRRRR strategy, but with really low or no money into these deals. So I often think about, like, if I were able to operate a little more in that time frame, right, that would have been pretty good for the career. But is what it is. I was
woulda, coulda, shoulda.
Woulda, coulda, shoulda. But I got one of those kind of in later on. It was about 2012. Yeah, it was 2012. So I built up some equity in those properties and then just refinanced, pulled some equity out of that. So I had a little more money to operate and tried to do that strategy. Got close to, I didn't get it with no money out of pocket. I think it was about $35,000 out of pocket. But found another property in Aurora, single family home. Did that strategy, used the hard money to acquire it, fix it up, refinanced it into the long-term debt, put a renter in there. So that took me to the 4 rentals, and then just kind of, hung out there for a while, had a pretty comfortable lifestyle with that, about $2,000 a month cash flow.
And you're also you were in busy raising 2 young kids still, right?
And still, the 2 young kids.
So let me ask you this, because I know, like, I'm in a situation, and a lot of our listeners are too. They're where you were now. Hey, they have starting a family or a couple, young kids at home, and just life is busy. Mm-hmm. If you think back to that time, like, what advice would you give yourself, or what advice would you give listeners who are kind of in that phase of life? Hey, they're scaling up their real estate investing while they're also scaling up and growing their family.
Right. I don't really. I wish, like I said, the thing that I look back on is I wish I could have been more active in that time when my son was an infant. But reality was I don't think I really could have been time-wise. But I think the biggest advice I could give to anybody is just, if you haven't gotten started, just get started. You have to get in the game at some point. So for me, it was that real start catalyst of, like I say, starting to have kids that really kind of pushed me over the hump on that and got me in there. But if you're just on the sidelines waiting, you're not going to get anywhere with that, right? So just get started, get moving, do something. And
I guess reading between the lines, don't worry about the perfect deal. Don't worry about market timing. Just get your foot in the your foot in the game. Get yourself in the game. Like you say, study the market, and just like we were saying earlier, kind of you got to do what the market tells you to do. You can't just be like, I'm going to come out and flip houses, or I'm going to come out and do buy and hold. Like if I tried to buy a buy and hold rental right now, I can't find anything that really fits my criteria with interest rates and property values, what they are. All right. So going back here, you've got 4 rentals, making about $2,000 a month in cash flow. You're hanging out for a bit, sounds like being a full-time dad, still a musician, all that. What did you do? When was your next investing step or evolution?
Yeah. So once we got a couple years down the road with those properties, and then, now the kids are a little older, getting into school age. So now I've got more time. So then I started looking at the amount of equity in those properties and figured, okay, now it's time to pull some equity out of those.
What was your ballpark equity back then?
I was looking to be able to free up about $500,000.
Okay. So a really good chunk of money.
Like real good chunk of equity there. So then I did some cash out refi. Didn't take quite all of that. So between a home equity line on my primary and then some equity out of those rentals, just to have some more capital to get out and get working again on some stuff. So then I'd find an odd flip here or there. I've never been able to be the flipping machine, just with the deal flow and all that stuff.
It's also a hard business to scale.
It's hard business to scale, and it's just so time intensive. And then plus, like I said, I like to just find what I know is going to be a good deal, or at least what I can tell is going to be the best deal that I can find. So if the margin is too slim, right, I'm going to pass on that deal because I don't want to get stuck on a deal. I'm not doing it just for the education anymore. I want to make sure that I can make some money on it. So then partnered up with my good friend of mine, Chris Lawhead, and then we started looking at some deals we could do together. He started looking in other markets, right? So then we were looking down on like Pueblo. He put together a deal in Pueblo that I passed on that he's selling now that I wished I'd gotten in on. Again, coulda, shoulda, woulda.
Are those the 2 4-plexes?
Yeah, the 2 4-plexes he's selling right now. So you're not gonna catch every deal, and your risk profile is your own, right? So just because somebody feels comfortable doing a deal, you might not feel comfortable doing the deal. You've got to, live with yourself, live with your decisions, and sleep well at night. So that was one that I just passed on that would have worked out well. And then we ended up expanding that out a little bit. And we ended up going to Amarillo, Texas, because we found what was not a good, sexy market in terms of appreciation or anything, but it was just steady Eddie. Looked like the cash flow was going to be good there. So we kind of put together like a syndication, and we're trying to get multifamily down there, but it's kind of like an old boys club, right? The people that were in that game were pretty entrenched, and it's a lot of relationships, and we just were having trouble making those relationships with brokers and stuff to get the access to some of those deals. So we ended up just cobbling together some more single family, because again, we knew how to do that too. So we took the idea of a bigger portfolio and just did it with assembling 22 single, duplex, triplex doors down there.
Oh wow, so you built a 22 door portfolio.
Yep.
And so you, Lawhead, were there other investors or partners in this group?
Yeah, there were some other partners that Lawhead knew from his high school days.
Okay. Mostly just like LP investors? Or just a mix of...
They were kind of more like the GP side. They do bigger deals, like hotel builds and stuff. So we were kind of leaning on them for some more of that expertise of kind of how to structure more of the syndication type deal.
And then how did that portfolio and out-of-state investing, how'd that play out?
That one was tough.
Oh, do tell, Matt.
That one was tough. So we do believe that we bought some properties in worse areas than we were thinking. We were thinking we were getting like trying to turn like C's into B plus, and seemed like we bought some kind of D and maybe even some F properties.
But that's a very common challenge with out-of-state investing. You don't know the market like you try East and West Colfax.
You try to know the market. We went down there, we did trips down there, and I guess maybe we should have driven some of these properties at night, kind of thing. So what rocked us there is because some of those areas were rough, vacancy, right, went way beyond the pro forma. So you're modeling about 8% vacancy, and we were hitting 25% on some of those properties.
Oh, that just kills your NOI.
Just totally killed it. So like I said, this was not an appreciation play. This was a cash flow play from day one, and then we're just not getting the cash flow we want. So that one is, like you say, you learn some lessons on what works, in this case, what doesn't work. So then we were kind of sitting on that one, and I had the money in that deal. So then it was like, these guys were like, well, what do we want to do? Do we want to sell, cut bait, and get out of here? And I was just like, no, like I've done this before where you make a mistake and time will erase some of the wounds, right? You can appreciate your way out. So that's what we did down there. We just kind of waited, and it took 4 years for us to kind of appreciate our way out of there. So all in all, it was about an 8% IRR in 4 years.
Okay.
So in terms of learning your lessons,
I mean, not a home run, but
not a home
could have
run.
been way, way worse too. It wasn't a negative 8% IRR.
It wasn't negative. So that was just, the power of just being patient and, like I say, just kind of waiting it out. So from some of those trials and tribulations, and then we've, had some wins. Like I had a referral partner, like bring me what was this, a condo flip. It was just a home run. And this was after the Amarillo stuff, or during, I think. But this was, getting this house fixed up and sold on the market, kind of at the end of the COVID craze in the springtime, and just totally crushed this one. Made like $58,000 on a condo, where I thought I was going to make 40, and then just it got bid up. And, you get some of those make you look like a champion. You get some of those like you get in Amarillo, make you look like you wish you knew what you were doing a little better. And then Lawhead and I we found a 4-unit building in town in Aurora that we thought was, again, going to be like a cash cow by trying this new strategy, finding larger 2-bed units, take part of the living room, turn it into another bedroom. So now it's converted to 3-bed. And then we were putting Section 8 tenants in there, and then thought, again, like I said, that looked like it was pro forma out as like a cash cow. Well, Section 8 tenants can sometimes be pretty hard on your property. So again, like the returns weren't hitting where we thought they would. So we ended up looking at an exit strategy on that one, which we hadn't really set out to do in the beginning, but we found a buyer for that one.
And so this was 2 or 3 years ago?
This was a couple years ago.
Okay.
Yeah. So we had a friend of ours, a broker. This is before I got my broker license. And he said, yeah, I can get you a buyer for that for a price that we thought was way too high. But we're like, if you can get that price, go for it. And so he did. He brought us a buyer at that price. So that was one of those. We ended up, getting out, like making 33% on our money in a year. So that kind of fell into that long-term flip. We sold that pretty close to just over the year mark.
And did you just pay the capital gains to take your money, or did you do 1031?
No, we just paid some cap gains on that. But like I say, you get into that long-term flip over that year mark.
Oh, it's a much easier tax bill to swallow.
So, like you say, you get your wins and your losses, or your education and stuff. But luckily, I've never had anything go negative. Like you said, the stuff that didn't go well has still been positive.
Yeah.
Like I said, I would set out to make 25,000 on a flip. I would make 9. We set out to do 20% cash on cash in Amarillo, make 8. So the mistakes haven't been anything god awful terrible, luckily. So.
Great. Well, that is always good to hear. Now, as we kind of come up here, because I know you and I got connected about a year ago. Mm-hmm. You were on one of our portfolio analysis masterminds, plugged in the Property Llama software and put some of your rentals into the software. Mm-hmm. You analyzed it, and then, that's how we got connected. And you started making a lot of moves with your portfolio and started making some different investments.
Yeah.
Talk about that, because this is, bring us up to like the current speed in the market now and the opportunities today.
Yeah. So like we're saying, when my kids got old enough and I wanted to be a little more active with my investing business, was just still struggling with deal flow or like just finding consistently good deals, right? Or like you said, the Amarillo thing where we're trying to make 20% on our money, we're making 8. So just some frustrations with really finding good enough deals. And, now that I've been in the game for a while, the amount of money behind me, has grown, right? It's not just $20,000 getting into a deal, So when I started looking at the portfolio through the portfolio analysis, I knew I had a bunch of equity there, but like I said, I didn't really know where to go with it to be productive with that. So it's just easy to sit on your rentals. They're cash flowing. It's just a familiar thing. It's not a bad place to be.
No.
Most of us like that. So I started looking at it though, when I looked at how much equity was trapped in there, almost $1 million of trapped equity, but I never really knew, like I said, where I could put that. So then started becoming aware of these passive investments. So really, when you get into the accredited investor world, right, you have a lot more options open up to you. So then I was pretty impressed by the sponsors that are on these passive deals and the returns that they're getting and the track record that they're getting. And so I'm looking at my portfolio from the standpoint of, I'm just not as good at this as these guys are. But I can get in this game because I'm now an accredited investor. So then I started being like, all right, so some of that cash that I had aside that I'd taken out of those rentals 5 or so years ago, like I said, I'd grown some here and there with some deals, a good flip and some buy and hold in Amarillo. But then I started allocating that money to these passive funds. And so, I put about 100,000 in one fund or 100,000 in another, 50,000 here and whatnot. And then we did the portfolio analysis, and then it was just like, okay, let me run some numbers on like what would happen if I sold some of these. So even selling those properties, even if I had to pay all of the capital gains on that, the numbers with getting into these passive investments were going to double the growth of my portfolio. So that got my attention.
So even though, hey, you sell a property, and traditionally, most people want to do a 1031 to defer, capital gains and depreciation and capture, you paid it. And even with that, you forecast to double your money.
Forecast to double the money, the growth.
Yeah.
Because, again, with the 1031, I wasn't really feeling like last year I could find a good rental to replace those rentals I had with. Right. Just low cash on cash return. Cause again, that's been one of my strategies since the beginning is the property has to be able to absorb the hits, right.
Yep.
And pay for itself. And then plus have some more money to put in my pocket. So without really being able to find that product anymore that worked like it did when I started, it was just like, what can I do that fits a growth model better? Cause, I'm still looking at 6 years until my youngest is out of the house. And so I was trying to get to a financial freedom number by that point. And the track I was on wasn't going to do it.
So do you mind sharing what that is? That like a monthly or yearly cash flow, I presume?
Yeah. So, I mean, it had been kind of that traditional, like $10,000 a month, $120,000 a year. And then I did something fun. I said, why don't I just double that number? And so I doubled that number and I said, let's make that the goal.
All right. I like what you're talking now.
Why not? Right.
Yeah.
So then
it's all a game.
It's just, yeah. I mean, after a while it feels more like a game. So, then I started looking at how I could kind of ladder my way into the passive investing and out of the active rental game. So like I said, in 2022, I think it was 250,000 in cash hanging around. And I started with investing that. And then I restructured the HELOC on my primary again in January. And then I sold in the early 2023, the two properties that were month to month that I could identify that could sell earlier. Right. Cause I want to sell in the spring, right? It's the ideal time.
Yep.
If you can control your destiny, that's when you want to be listing your properties.
Yeah.
So when I decided in the wintertime of 22 that this is the track I was going on, I had enough time to get those month to month tenants notice, get them vacating in the middle of January to get fixed up to be listing into February.
Can you walk us through kind of high level, just one of the numbers on these properties?
Sure. So like in terms of like sale price?
Yeah, just like, I mean, just like, hey, when you sold two this year, just walk through like, hey, what you sold it for,
sure.
What you walked away with, rough idea, capital gains, how you mitigated, just some ideas like that.
Yeah. So,
or numbers like that.
So one of them was a 2-bed, 1-bath in, East Denver. That was actually the one that I got stuck with trying to flip. That was my first rental.
Oh, from 2010?
Yeah. So that one ended up selling for $380,000. I only had to put about $15,000 into that one. And again,
to fix it up.
Just, it needed some paint, carpet.
That's pretty standard for standard. Rentals.
It needed just the cosmetic stuff. And then the other one, it was a 4-bedroom home ranch in Aurora. That one had a bit more deferred maintenance on it. That one was like $45,000 worth of rehab. And so by the time I sold those, paid back the rehab costs, set aside, because I'd owned those for a long time. So I was like, it was going to be $160,000 in capital gains.
Yeah. This Aurora property, what'd you buy it for? What'd you sell it for?
Oh, so I ended up selling that one for $480,000.
So $480,000, and what'd you buy it for?
Bought that one for $125,000.
Okay. Yeah.
And that other one that I sold for $380,000, I bought that one for $60,000.
Okay. I mean, so awesome appreciation, but
Incredible.
Also you get some of the tax bills on there as well.
Yeah. So the tax bills come in. Like I said, I had taken cash out of those deals in the past. So you really want to look at those numbers if you're looking to liquidate, especially if you've taken cash out, because your tax burden is on the basis when you bought that property.
Mm-hmm.
You don't care how much the debt is when you sell it. So when I looked at, like I said, the analysis of those angles there, what it would need for fix up, what I could sell them for, paying the capital gains, and then what I could reinvest. I was going to have about $250,000 more to invest there. But then I started figuring out more about the depreciation shares on some of the passive investments, and found with working with a new accountant who understands the depreciation more than my old accountant did. I'm able to save about 80,000 on the capital gains right away. So
say those numbers again. I want to make sure I understand this.
yeah, so I was looking to have 250 to invest,
Okay.
and then it grew to a little over 300,000 after I can take advantage of the depreciation. So that's basically deferred taxes that I can reinvest today, and then later on when that fund kicks that money back out, then I'll have to pay that back to the government.
So help kind of connect some dots here. So I know, if you don't mind me sharing this, I know you invest in like one of, Terrence Doyle's last value add fund, which is, a multifamily value add fund. And one nice thing about those funds is they're not new construction. You buy property, you cost segregate it, and you can get massive amounts of depreciation in the first year or two from cost segregation, accelerated depreciation, a couple other things on there as well. And so by investing in that, even though you didn't do a 1031, a lot of that depreciation helped offset a big bite or about half of your expected capital gains and depreciation recapture.
Absolutely.
Cool. So if you guys, obviously we're talking about this stuff, always talk with your CPA. Matt and I are not CPAs, nor are we your CPA. If you need a good CPA, we can recommend you some, so reach out to us. But there are some very powerful strategies to help offset it and then kind of keep your money in growth mode, because that is where the distressed assets and opportunities right now in the commercial properties.
Yeah. And like I said, just with looking at like the option of doing a 1031, what I could buy, it just didn't make sense to not pay those taxes and get into an investment that didn't perform as well as, like you say, like Terrence Doyle's doing.
Yeah.
So it made sense for me. And again, this, your risk profile is what it is, or your strategy is what it is. When I looked at, like I said, being able to double the growth of my portfolio and ladder my way into these investments so that in the future, I've just got, hundreds of thousands of dollars coming out of these investments annually to reinvest or scoop some off if I need to for annual expenses for my family.
Talk about the ladder, because this took me a while to understand myself, and that's one of the strategies I incorporate now. And it's a different way of looking at investments rather than just pure monthly cash flow from a rental. Because these syndications and funds, they are structured differently. So talk about what a ladder is and how you're structuring it.
Yeah. So just not wanting to kind of cut bait all at once, for one thing. And also, just like I said, so I invested some available capital in 2022. And the strategy came from some of the funds that I've invested in are like about a 5-year term on the fund.
Yep.
But a lot of them, through sale of assets or refinance, could be returning capital in year 3. So I was like, okay, well, if I'm getting capital back in year 3, those 2022 investments should be hopefully having some capital come back in 2025. So then I started looking at, well, with my strategy of getting some of that available capital invested now, and then the time frame of selling those rentals, it just kind of created this ladder of not investing everything all in 1 year, spreading it out. Plus, then I get I get to hang on to some of that cash flow from these rentals, right? The 2 that I sold weren't really great cash flowers. I had a friends and family in one of them, so I was actually losing money on that one. And then the other one was decent but under rented. So
like a long-term tenant, just under market.
Long-term tenant, but the reason that one was under rented is because they were getting government assistance, and there was only 2 of them in that larger house.
Okay.
So, like I said, that is what it was what it was. It worked at the time, but those 2 were easy to sell because of they were underperforming, not only from a return on equity standpoint, but just even on a cash flow standpoint. And so reallocating those funds over the 3 years with the ladder concept, right? Invest in 22, invest in 23, invest in 24, should have capital return coming back in 25.
Yep.
And then that just seemed like it just set up a real natural flow to just money coming in and coming out of these passive investments, where kind of changed my mind, like you're saying, on cash flow from like monthly cash flow from a rental to just like larger chunks of invested money that become available again after a period of time. It's 3 to 4 years. And then, like I said, when I'll look at where I'm at financially in those times, like if I'm, doing enough other business where I don't need to touch that capital, it'll just go back and reinvest. If I look at my situation, which I look at very much annually now, right? So I'll look at my reserves annually and be like, all right, if I've got enough annually in reserves, I'll reinvest all of that. If I need to replenish some of those reserves, I'll just take some of that out and replenish. Because then, about 3 years, you get the principal return. And then again, like the gain is going to come around year 5. So, right, you get down the road a few years on this, and it's just like going to be like a little Ferris wheel of money coming in and out of these deals.
Yeah, it's a conceptual shift, but it's a very cool way to kind of like add a different, investment cash flow and capital stack of returns to real estate investing. And then you mentioned investing in 2024. You're selling your other rentals next spring as well, right?
Yeah. So I just re-signed what will probably be my last lease agreement with a tenant. I've had this tenant in this house for 8 or 9 years, and he's smart. He likes to always have a lease agreement in place, so I can't just get him out month to month like I did those other tenants, right? So he likes that security. So even with getting him out in January, again, I set it for January 15th this year. Worked well last year, so I'm just going to do the same thing. So we signed a lease agreement through January 15th, and then those are 2 more in that East Denver neighborhood that we'll rehab and sell, and then I'll have that capital available. And then we'll have to do the same thing, rehab them, get with the accountant, the CPA, figure out what the what the capital gains are on those. I already have an idea of that, but property values may change. I may get more for those. I may not.
Probably pretty similar to what you did this year, right?
Should be similar. Yeah. And then, I obviously ran those numbers for next year on this year's prices, just so if there is any upside, that's just a little gravy on the
a couple sprinkles on top,
little sprinkles.
Yeah,
and then we'll just see what funds are available, and obviously, like I said, I'm kind of looking more towards something like Terrence Doyle offers with a high depreciation.
Cool. Matt, this is fantastic, and part of it kind of want to help connect the dots, because I know more and more people getting to know who you are, what your name is, through the portfolio analysis mastermind, and just kind of having some overlap in our networks. Recently we started working together on, putting, deals together and raising money. Mm-hmm. And so I know some of our listeners have actually talked to you, or you've, called them or texted them. Yep. And so I'm very happy to share that, as of a couple of weeks ago, we officially started working together on putting more deals together. And obviously you can tell with Matt's background, like he has walked the walk. He has been in the trenches. He's taken his black eyes. He's taken his wins. He's in the game himself as well. And, he's helping us there as well to, raise money for Terrence's next deal and future deals as well. Just so everyone knows, hey, you'll be hearing from Matt. If you do, he's on the team. Also, I want you to know, Mac, use Matt as a resource. One of the things I love about podcasting is I get to talk to you and some other successful investors. Hey, what have you done the last 5 years, 10 years, 15 years? What can I learn? What can my audience learn as well? So if you guys want to reach out to Matt, please do so. We'll put his contact details in the show notes. But Matt, from a high level, we got people kind of in your position now where they have rentals right now. Your read on the market is just, you're moving all passive, it sounds like, right?
Yeah, I just I can't see a downside to it right now from my vantage point with my goals in terms of growth, and then like I said, how it looks like those monies will come back out of these investments. So yeah, I've decided to make the shift into this, and it's one of those things. If I get into it, it's not exactly what I think it is, or I decide I want to do more active stuff later. Again, the market will be different in 3 to 5 years when those projects come due. And
you might take that money and go buy some rentals in 5 years.
Yeah, you could go buy some rentals. So it's not like it could be a forever switch. It could not be a forever switch. I don't know. I'm just in the mindset, like we said, just kind of taking what the market is showing me as the best option I have at the time. And so right now, like I said, just taking some of the lumps I've had with syndicating deals and doing some out-of-state investing, working pretty hard to make 8% on my money, handing it to someone like Terrence Doyle, who I feel pretty confident is going to, double that or exceed that. That just, helps me feel confident in those decisions. Okay. It's just the operators are just outstanding.
Awesome. Well, thanks a lot. And anyone out there, if you guys have questions on, finding these deals and, of course, doing due diligence on these deals and sponsors, it's a different type of underwriting than, hey, what's the operating expenses on the rental property? let us know. But also, like, we are gearing up to start our next portfolio analysis mastermind sometime in end of Q3, early Q4. So exactly what, Matt was part of last year. He'll be a big part of this one. So keep your eyes out for that. If anyone's out there is eager to go get their properties analyzed and do a portfolio analysis session, go to propertyllama.com, go create a free account, put your properties in there. Then just ping me or ping Matt. We're happy to get on the phone with you and help you kind of give our 2 cents on your portfolio and see what opportunities that, we'll give you our 2 cents on opportunities, upside, downside, and walk you all through that. I mean, that is like where a lot of our passions lie as well.
Absolutely. I mean, that'd be some advice I'd give people as well, like you were asking earlier. It's just like once you've grown your portfolio to a point where I have, and maybe you're in a similar boat, get involved in the team game. Right.
Yes.
Get involved in the team game. When I started teaming up with my good friend Chris Lawhead and business partner, it got easier. It just was nice to have somebody to bounce ideas off of. He kept me from doing some stupid things. I've kept him from doing some stupid things.
The way it works.
And just expanding this network with you and it feels like an amazing place to be. I just feel like I know more. I feel like I'm getting to know more, and I want to help other people just reach their goals. So let's just get together, like you say, analyze it, figure out the best strategy to help people moving forward. That hits my passion spot right now.
I love it. Well, Matt, thank you so much. I look forward to having on more podcasts, more webinars, and just I'm excited to have you on the team. And we're all aligned on investing strategies, but most importantly, helping investors figure out what they can do with their portfolio.
Absolutely.
So thank you so much.
Thank you. Really
Anyone out there, you guys have any questions, Matt's contact details in the show notes. Shoot me an email. I'm happy to introduce you guys that way as well. But plug into us for how to analyze your portfolio. Contact Matt for more detailed breakthrough of his numbers. And of course, if you need a CPA recommendation for a CPA that actually knows real estate, please reach out to us. Matt, thanks again, man. This has been a blast.
Yeah, appreciate it.